Hi everybody, this is Phil Haloka from Complete Captive Management Services. Today we continue the conversation about captive accounting with a very exciting capital versus collateral discussion. What's the difference? Well, we touched upon this in prior videos, but we're going to look through the difference through the lens of how it's accounted for on the P&L and a balance sheet of a captive insurance company. So these two terms, capital and collateral, are very commonly interchanged within the marketplace. They are not interchangeable. This means one thing, this means something different. So let's address that. Before we talk about it, the title differences, let's talk about how they're expressed and why they're expressed in the manner that they are. So the insured or the employer has a P&L, profit and loss. $1 million revenue, $700,000 of expenses. Part of that expense are insurance premiums. So they're what's called a deductible expense. Many times you're going to hear me say capital and collateral is not a deductible expense. This is what that looks like. Okay? So in this example, $700,000 of expenses leaves $300,000 of profit. And in the U.S., C corporations are taxed at 21%. That's the income tax rate. So you multiply $300,000 by 21%, gives you a $63,000 tax expense, leaving you with $237,000 of cash money. The fruits of your labor yield this amount of money. Okay? So now the question becomes, hey, let's join a captive. Let's start a captive. What does that look like? Well, the first question is, how much is it to join the captive or to start a captive? This example, it's $100,000. So that $100,000 comes from this bucket of money, not from this one. So what happens is, the IRS says, I don't care what you do. If you want to join a captive, go ahead. It's not a deductible expense. Meaning this $100,000, if it was a deductible expense, it would be up here, leaving $200,000 of profit, and you're now only paying 21% of $200,000, which is less than $63,000. So capitalization or collateral is not a deductible expense. So we've got to take $100,000 from the profit bucket, leaving $137,000. Why is that important? Well, companies have what they call an internal rate of return, meaning they could take this $237,000 and reinvest it in their business, and that's going to hopefully generate a return on that investment. Let's say that return is 10%. Well, if it is, you don't have $237,000 anymore, you have $137,000. So you're deleveraging the internal rate of return effect when you join a captive or start a captive. So that's just important to understand. The takeaway message is this $100,000 dilutes the cash money left in their bank account. That's the takeaway message. Okay? We also know when we talk about this is there are two types of captives. There's a reinsurance captive or a direct writer captive. A reinsurance captive has a fronting carrier, meaning the captive is reinsuring the policy issued by an admitted carrier. And the fronting carrier defines what the collateral is. So collateral is only paid to a fronting carrier. That's a takeaway message. So when you join a group captive and you're told that the collateral cost is $100,000, that means the fronting carrier is keeping that $100,000. Now, in some instances, you may join a reinsurance captive, but the fronting carrier says, hey, my collateral request or requirement is $75,000. That leaves $25,000 to be treated as capital in the group captive. And you won't know to ask that question unless you understand the difference between collateral and capital. Hopefully you do now. Okay? So the takeaway message is collateral goes to the fronting carrier, capital stays with the captive. Now, if you're in a direct writer captive, this $100,000 is capital. Because in a direct writer captive, there's no fronting carrier, therefore there's no collateral. This capital is much like I'm starting a business and my seed money, my startup money is $100,000. So I'm going to write a check for $100,000 and I'm going to give it to my new business. And in return, my receipt for that $100,000 is, we'll say, 100,000 shares. Each share is $1. So the captive's balance sheet will show $100,000 of cash, which is an asset, and $100,000 of shares or capital, which is an equity. Okay? In this model, the direct writer model, that becomes your basis. The insured's investment in that captive is $100,000. So 10 years down the road, you shut your captive down and there's $1 million in that captive. Well, you're going to pay long-term capital gains on $900,000, not $1 million, because your investment was $100,000. Now that's a wee bit of advanced tax planning. Your situation may be slightly different, but that's what we're trying to talk about here. Your investment in a captive is always going to be capital. That's the difference. Collateral goes to the fronting carrier, capital goes to the captive. They are not interchangeably. Hope you can pick that up now. Okay? So, hope this was interesting. Next week, we're going to talk about reporting aggregate liability on your P&L and your balance sheet when the policy is issued to you. We'll talk to you next week. Bye now.